Welcome to the Deep Dive. Today, we're taking a focused look at Culp Inc. That's ticker CULP. They just had their Q1 fiscal year 2026 earnings call. They're in the mattress and upholstery fabrics business. And this quarter, well, it really showed a classic conflict we're seeing a lot lately.
Yeah, operational strength meeting, some pretty serious macro headwinds.
Exactly. They did great internally on efficiency, cost control, you name it. But the top line, that still signals some real pain in consumer demand.
It really does. And what's fascinating, I think, is how management used restructuring to, change their whole operating floor, improve things dramatically.
But the market didn't seem to care.
Well, the market's focus, initially anyway, seemed laser focused on that revenue shortfall, kind of overshadowed the internal wins. So today, let's unpack the financials and maybe talk about this integration strategy they call Project Blaze. See what it means for you.
Okay, let's do it. Starting with a snapshot of the key results. It sort of explains why the market reaction was, let's say, measuredly cautious after the call.
Right. So revenue landed at $50.69 million. That's $50.69 million.
Which was a miss.
A significant miss against consensus, yeah. And it represents a year-over-year decline of 10.3%. That top-line weakness, that's still the main red flag here.
But, and this is where it gets really interesting, despite missing on revenue, the GAAP EPS, the earnings per share, came in at minus 2 cents, negative 2 cents, which, handily beat the consensus estimate of negative 12 cents.
Wow. Okay, so a big beat on the bottom line.
Driven purely by those internal efficiency gains. Just dramatic improvements there.
So the core story is pretty clear then. Management is pulling all the right levers inside the company. They're controlling costs incredibly well in a tough environment.
But they can't control the housing market.
Exactly. They can't control interest rates, discretionary spending, all that external stuff.
Okay, let's dig into those operational highlights then, because like you said, they controlled what they could.
And they really shone there. Gross margin was, frankly, the star. It rose to 14.3%, 14.3%.
That's a big jump year over year.
Huge. 530 basis points. That's 5.3 percentage points better than last year. Massive leap in efficiency.
And that flowed right down.
Directly. It translated into operating income of $1.6 million. $1.6 million, which is, just a massive swing compared to an operating loss of $6.9 million in the same period last year.
Okay, so that swing, that really validates the cost discipline, the prior restructuring they did.
Absolutely.
Looking at the segments then, where did that margin improvement come from?
Mostly bedding. That segment managed to grow its gross margin to 10.5%, which is a huge recovery considering it was negative 1.2% in the prior period.
So massive margin recovery in bedding. What about sales?
Sales were basically flat. Came in at $28 million, $28.0 million. Now, management did claim this was supported by some market share wins.
Flat sales, but market share wins in a down market. You have to be a little skeptical there, right?
Yeah, a little bit. It usually means you're just declining less than your competitors are. It's still an operational win, don't get me wrong, but you'd want to see some tangible contract wins or something to really, buy into the market share gain narrative fully.
Okay, fair enough. What about the other side? Upholstery?
Upholstery revenue was more challenging, down about 20% year over year, $20.6 million. $22.6 million.
20% drop. Ouch. What do they blame that on?
They pointed to two main things. First, the lingering effects of, tariff volatility.
The China tariff.
Specifically, yeah. Last spring, they got hit with these incredibly high tariffs, over 150% on some China imports.
150%. That's basically a stop sign.
Pretty much. Management had a tough call. Ship and eat that cost or just pause. They decided to pause residential upholstery shipments for about 5 weeks. So now they're dealing with that air pocket in demand from that pause.
Okay, that makes sense. And the second factor?
Just an uneven year-over-year comparison. Apparently, a large residential fabric customer front-loaded a bunch of purchases in Q1 of last year.
So it made this year's Q1 look worse by comparison.
Exactly. Made for a tough comp. Management thinks that particular issue is smoothing out now, though.
Got it. And despite all this sales pressure, tariffs, comps, they still managed positive free cash flow.
It did. Positive $310,000. plus $11.31 million after capital adjustments. And that's critical for them right now.
Right, generating cash internally,
Yeah.
not having to borrow more while they restructure. That's a huge priority.
Definitely.
So, okay, the internal financials look much healthier, balance sheet improving, but the market wants that top line to stabilize. How are they tackling the structure to maybe help with that or at least improve profitability further? You mentioned Project Blaze.
Yes, Project Blaze. This is the big structural shift they announced. It basically integrates the old bedding and upholstery divisions into one single unified business structure.
Okay, breaking down the silos. What's the expected impact?
They expect it to generate at least $6 million in additional annualized cost savings and efficiency gains.
And wait, that $6 million is on top of the savings from last year's restructuring.
Correct. It's additive to the $10 to $11 million in annualized benefits they already got from the North American restructuring they did last year.
So they're kind of double dipping on savings here, streamlining the organization and optimizing their physical footprint by moving stuff into their own Stokesdale facility in North Carolina.
That's exactly it. Consolidating operations, simplifying management structure. But there's an important consequence here for how you as an investor track the company.
Oh, what's that?
Because the SG&A cost selling, general, and administrative expenses are now managed on a consolidated basis for this unified division. The company will no longer report operating income at the segment level. They'll only report down to the gross profit line for bedding and upholstery.
Whoa, wait, so we lose visibility. We won't be able to see directly how bedding's operating profit compares to upholstery's anymore.
That's right. We lose that specific line item.
How should investors, deal with that? That seems like less transparency.
It is, technically. We have to sort of trust management's assertion that the overall efficiency gains from integrating outweigh the loss of that specific reporting detail. Our focus, yours too, will need to shift. Instead of tracking segment operating income, we'll have to really watch consolidated SG&A as a percentage of total sales.
Okay, so a shift in focus required for analysis. Got it. What about the outlook then? Did they give much guidance?
Well, given the market uncertainty, they kept forward guidance pretty limited, which is, understandable.
Okay.
But they did express confidence. They expect sequential overall sales growth in Q2 and actually continuing through the rest of fiscal 26.
Sequential growth. So better than Q1.
Yep.
And improving from there. On what basis? Market recovery.
Interestingly, no. They stress that this expectation is based on their internal efforts, especially those cost savings kicking in. They're specifically not relying on a big market rebound to hit these targets.
Okay, that's important. What's the key number to watch for Q2 then?
The guidance is for adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, to be near break even, maybe slightly positive. That's the immediate checkpoint. If they hit that, it validates the restructuring and Project Blaze savings are flowing through as planned.
All right, let's connect this back to the bigger picture for a second. Did management talk about the overall industry?
They did. They cited some industry data suggesting this down cycle in home furnishings. It's been really drawn out, going way back to 2020, really.
It feels like forever.
And because of that, they believe there's significant pent-up demand building, especially for things like mattresses, where people replace them on a cycle, and that cycle is now long overdue for many consumers.
Right, the replacement cycle theory. Makes sense. But the macro environment is still tough.
Oh, absolutely. Housing turnover is slow. Big ticket spending is cautious. But Culp stressed their competitive advantage here is their flexible global supply chain.
How does that help with tariffs?
It helps them mitigate the fluidity. They emphasize the really hard part isn't necessarily the current level of tariffs, it's the constant variability. Hard to plan long term when the rules keep changing. Their supply chain lets them shift production or sourcing more easily than some competitors, apparently.
Okay. Now, you mentioned that some things came up in the Q&A, sort of hidden assets.
Yeah, two really interesting points came up that provide kind of a safety net or a floor for the business value. First, the company has $88.1 million. $88.1 million in U.S. federal net operating loss carryforwards, NLLs.
88 million in NLLs. That's huge. What does that mean practically?
It's basically a massive tax shield waiting to be used. Once Culp returns to sustained profitability in the U.S., they won't have to pay federal income tax on the first $88 million they earn.
So that future profit goes straight to the bottom line, or to cash flow instead of taxes.
Exactly. It's a huge boost to future cash flow potential, keeps cash in the company.
Okay, that's significant. What was the second hidden asset?
It relates directly to Project Blaze and that consolidation. Their main manufacturing facility in Stokesdale, North Carolina.
Uh-huh.
On their balance sheet, its net book value is only $12.1 million. $12.1 million.
Oh.
But management estimates its actual market value, if they were to sell it, is significantly higher, potentially somewhere between $40 and $45 million. $40 million to $45 million.
Wow. So there's like a $30 million difference between what the accountants say it's worth and what it might actually fetch on the open market?
Precisely. And that creates a really tangible asset floor. If you look at Culp's total market cap after the earnings dip, that gap, that potential $28 to $33 million of unrecognized value in just one building, provides a pretty substantial layer of, untapped liquidity or asset protection for you as an investor. It suggests the sum of the parts might be worth more than the current whole.
Very interesting. Okay, that leads us perfectly into our not financial advice segment, where we pitch an outrageous but maybe plausible trade idea, something you might discuss in an investment committee meeting.
Right. And given everything we've discussed, the stock dip after earnings, the clear revenue miss BUT, that strong margin momentum from internal work, we see a potential dislocation here.
A disconnect between perception and reality.
You could say that. So the trade idea we're proposing is a short-term long position with asset-backed protection. The goal is to target a correction in the stock's valuation as Project Blaze really starts to show up in the numbers.
Okay, break that down. Short-term long with asset-backed protection.
So the idea is go long CULP shares. Buy the stock. You're betting that those $6 million in Project Blaze cost savings.
Ones that are guaranteed and additive.
Right. And which are mostly going to hit the results in the second half of this fiscal year. You're betting those savings will ensure the company hits its sequential profitability targets, especially that Q2 goal of breakeven to slightly positive adjusted EBITDA.
Okay, so that's the long bet on management execution and the guaranteed savings. What about the asset-backed protection part?
That's where we get a little creative. You finance the trade, or at least protect the downside, by selling deep out-of-the-money put options.
Selling puts.
Yeah.
Okay. How deep out of the money?
Well, you'd look at that Stokesdale real estate value. It's on the books for 12 Mellers, maybe worth 40, 45 LM. You sell puts with a strike price far below that estimated market value, maybe somewhere reflecting closer to the book value or even lower.
I see. So the rationale is?
The rationale is powerful, I think. The market right now seems to be pricing in mostly the near-term revenue risk, right? And maybe ignoring or discounting those guaranteed cost savings from Project Blaze.
And definitely ignoring the floor value provided by that 40 million plus real estate asset and the 88 million in NOLs.
Exactly. So this trade uses the market's current fear, the implied volatility, to your advantage. You generate income, premium, by selling those puts way down low. Meanwhile, your long stock position benefits if management executes, the margins hold up, and maybe the stock gets re-rated based on that hard asset value we just discussed.
So it's really a bet on management hitting their internal targets, but it's backed by hard assets you can, almost touch.
That's the idea. Execution backed by asset.
Okay. So wrapping up our deep dive on Culp's Q1 fiscal 26, it's a clear story, really. Strong operational recovery, great cost reduction, getting the house in order.
But definitely dampened by that revenue weakness, which is driven by the soft macro environment and that tariff volatility noise.
So the focus now shifts completely to execution, doesn't it?
100%. Can Project Blaze deliver that promised $6 million in extra savings on schedule? And critically, will that Q2 adjusted EBITDA actually hit their target of break-even to slightly positive?
Because if they can just stabilize that top line, even keep it flat, while maintaining these much higher margins they've achieved,
then the whole investment thesis could change pretty dramatically, yeah.
All right, we'll leave you, the listener, with maybe this provocative thought to mull over. Culp seems to be making all these structural moves to be profitable without relying on a market recovery.
Right. They're tuning the engine while it's idling.
Exactly. Think about that tuned engine. Right now, it's idling efficiently. But when that pent-up demand they talked about, especially for mattresses, when that finally gets released, when consumers finally step on the gas pedal, how much faster, how much more explosive could the subsequent operating income expansion be, given the operating leverage they've now built into the system? That's something worth thinking about.